Today we'll quickly introduce a simple, long-only, algorithmic volatility contraction breakout strategy, trading the NASDAQ 100 CFD on the H1 timeframe. You can find the strategy code in the video description. Let's dive into the performance.
Welcome to the world of algorithmic trading.
In this educational series, we explore whether it's possible to develop a robust trading strategy. Is it achievable? Let's find out together. Disclaimer: trading involves significant risk and may result in capital loss. This video is for educational and informational purposes only and does not constitute financial or investment advice.
Strategy logic and edge. This is a long-only strategy. Since stock indices generally tend to rise over the long term, short-side strategies are often more difficult to develop. The entry logic is straightforward. We place a market order at the bar open when the Schaff Trend Cycle indicator crosses above 54, provided that the highest high of the last 3 bars is still below its 34-period SMA. We use the Schaff Trend Cycle as our primary momentum filter. It combines MACD with a stochastic process to identify cyclical trend changes more responsively. However, it's certainly no holy grail. Like other oscillators, the STC can produce false signals in sideways markets. Furthermore, the entry itself is driven by volatility contraction rather than price expansion. Instead of a classic breakout to new highs, we are looking for a bullish impulse that emerges from a compression phase below the moving average. Risk management and exits. To manage risk, we use a dynamic stop loss based on yesterday's low and a dynamic profit target tied to the weekly opening price. Regardless of the SL or PT, all positions are closed if the Schaff Trend Cycle rises above 82.5. The Schaff Trend Cycle also acts as an indicator-based emergency exit, overriding the stop loss and profit target, which can affect the strategy's risk-to-reward profile and increase reliance on a single indicator. In algorithmic trading, this kind of mechanical exit with multiple conditions is common, even though it adds another layer of complexity. Weekend and robustness. We keep positions open over the weekend. The strategy is robust enough to handle Friday closes, though the total profit would drop from roughly $928 to $730. During robustness testing, I found that the system remains profitable even if positions are closed daily before the session ends, although that setup is no longer optimal for algorithmic trading. Profitable algorithmic strategies should remain viable even under significant parameter changes or time frame variations. Backtest and verification. The backtest length is limited by the available broker data. However, the strategy has shown consistent results during live forward testing on a MetaTrader 5 demo account for over 6 months. It passed various robustness tests quite well, including Monte Carlo simulations with 1,000 runs using randomized parameters, which suggests it's definitely worth further exploration. When designing strategies in algo trading, Monte Carlo is one of the tests used to check whether a strategy is not fragile and can survive rough changes in logic or in the trading data. Automated trading runs without our direct control, so we want trading strategies to have at least a real chance to survive unexpected conditions. Performance stats. Since 2018, the strategy has executed 510 trades with a 37% win rate and an average trade duration of about 4 hours. Using a small 0.1 lot size, the average win is $8, while the average loss is just over $2. It's worth noting that one large trade in April was likely an outlier, so we shouldn't count on similar moves in the future. This result comes from a backtest that included in-sample testing, out-of-sample testing, and a period of live trading on a demo account. Key metrics. The strategy shows a profit factor of 2.36 and an SQN of about 1.7, confirming a statistically valid edge. With a 37% win rate and a payout ratio of roughly 4-to-1, the expectancy remains solid at around $1.8 per trade, and a Z probability above 95% indicates the results are unlikely to be random. Maximum drawdown is extremely low at just 0.53%, resulting in a strong return to drawdown ratio of around 17. The relatively low CAGR of about 1.3% is mainly due to very low market exposure, only about 2.8% time in the market, and conservative capital allocation, not a lack of edge. Closing. The total net profit already includes spreads, commissions, and slippage. I'm continuing to monitor this strategy, and if it proves itself during deeper market turbulence, it will be a very interesting study material. You can examine the full pseudocode in the description below for free. If you enjoy these videos, please subscribe. Next time, we'll dive into more algorithmic trading insights. Thanks for watching. Good luck with your trades, and I'll see you soon. Remember, trade edges, not hopes.
If you enjoy the world of algorithmic trading, make sure to subscribe so you don't miss any upcoming videos.